Hello, I believe we are now live at yet another Vega Fairground or Testnet Jam. Today I have Vitold with me, and we'll be talking about the theory behind price monitoring within the Vega testnet and Vega ecosystem. For those that don't know that are new to this Fairground Testnet Jam, this is a weekly event. We hold it every single Thursday at 6 p.m. UK time or UTC +1. And typically this is an event where we go through the first 20, 30 minutes, we'll go through a specific feature or aspect of the Vega testnet, which is called Fairground. And that's usually with a different member of the team each time. And although you'll see some faces more regularly than others. Today we're covering price monitoring. For all discussion around anything that the talk covers, please message in the Twitch chat. We'll be posting links and we'll be answering questions as we go along, as we do each time. And then anything that we don't cover in the Twitch chat, if you would like, you can come and chat with the team separately afterwards, where we all go into a Zoom room. And in that room, you can have troubleshoot any questions you might have, talk about things not covered in the school, and get any general support you might need around the Vega testnet. Without further ado, I'll hand over to Vitold, and then I will be behind the scenes managing the Twitch chat, and I'll come back at the end. Bye.
All right, I guess now it's on to me. So thanks a lot for the intro, Tegan, and I'm moderating and running this. I'll count on you to relay the questions from Twitch whenever you think is best. Either feel free to interrupt me, or maybe some of them can be left till the end. And after that, I'll hang out in the open Zoom room in case anyone would like a bit more of a lively discussion rather than just, answering to text questions, which is fine too. Okay, so today is about price monitoring. Let's see if I can share my screen. Hopefully that is visible. Yeah, so I'll be covering a little bit of a theory and then playing with the UI to hopefully show you how it works in practice. But to make sure we build it from the ground up, let's maybe quickly discuss how continuous trading works. I'm sure most of you know that, but I like to start from the basics because it just gets everyone on the same page and helps me to lead a decent argument. So yeah, this is the order book. This market isn't particularly healthy. It's actually an auction, but I think that's enough for us to demonstrate what I would like to do. So when the market is in continuous trading, right, there's a bunch of limit orders sitting on both sides of the book. So the buy side here, the sell side here. When the new order comes, it is checked whether it crosses with another one. So let's say a buy order for 20.77 came in. So that would be crossed with those sell orders, and it will be getting filled with them, going from the cheapest to cheapest up until its volume is filled, right? So if it was something like 50, it would trade with a few of those. If it's not crossed, then it just lands on the book, right? The next order comes in, it could be a buy or a sell. Again, if it's a sell and it crosses with a buy, it results in a trade and takes off the other books of the other orders of the book. And if not, it just lands on the sell side, and the sort of story continues. And every time there is a trade, the market price changes slightly. It usually follows something resembling, a Brownian motion, possibly with some jumps. And the market happily sort of carries over. And that's all well and good, but there are cases when we have big price moves. And again, there's nothing wrong per se with a big price move, right? Because there could be an information, let's say we're talking about equities. So perhaps the CEO has embezzled, half of the company's budget or whatever, then obviously the price will drop and the market will adjust quickly because no one will want to buy them at the previous higher price, and the market will go way down and find its equilibrium somewhere. And that's fine, right? That's what the markets are for. They are meant to incorporate the information coming from the news and anywhere else, to try and at every point in time, taking discounting into account, and sort of projections, determine the fair value of this company at this point in time. And we're obviously not here to change that. We don't want to stop this. But the thing is, some of the price moves are not really genuine in some sense. But the problem is that it's not really possible to tell that beforehand when you see the order. It's sometimes quite obvious retrospectively, right? Because you could see a huge dip in the market that maybe then jumps back to roughly the previous level within, I don't know, 10 seconds or a minute or whatever, depending on the market. And this could be for a bunch of reasons. Like it often is the artifact of a market microstructure. So maybe, the simplest and sort of most trivial case would be when someone places a market order, right? So ticket. Yeah, so this will buy or sell at a market, and let's say I want to buy 100, but for some strange reason I add a bunch of zeros in. So if I were to execute this, I'd either buy or sell. I would likely eat through a lot of the orders here, if not all of them, and I would push the price very far. And then I would, if that was a mistake, I would likely try to take the opposite position in the market quickly because I was never after such a big position. So the price will go to some different level depending on how can I trade. I would lose a bunch of money in fees and whatever the net price move ended up being. So that's kind of my own stupidity, and I'm paying for that. So that's kind of fine. Some sort of a Darwinism, I guess. If I do it too often, then I probably won't be in a position to make those orders anymore. But there can be, and this is the sort of trivial case, and I don't think these happen too often these days. But there could be other reasons, like some temporary shock to the supply, maybe some liquidity provider dropping out of the market and the liquidity on the book drying up temporarily before someone has a chance to react. And so this will then usually be shown as, again, a big jump and maybe an increase in volatility for some time, and then things will resume on some previous path. Let's say, obviously no one knows what the path is, but you can often see if you apply some moving average that the price is following some fairly well-behaved path. And at Vega, we are marking to market on every mark price change, and mark price changes with every trade. So whenever there's a new trade that updates the mark price, which then results in transfers between those that made the money on the most recent market move and those that lost the money, right? So if I was long and the market went up, I made the money, but if it went down, I lost the money, and I would pay it in, and it would get distributed among those that had the opposite position in the market over that last instant. And that's also fine, right? That is something that allows us to maintain very safe markets, because your collateral only really needs to cover, the market move over a very short period of time. But what happens if the price moves by too much and you burn through all your margin account, and let's say there's no more funds in your general account, then you will get closed out. Again, nothing wrong with that, right? That's just part of the risk management of the system. We then want to offload that position to someone that is better collateralized, so that he can then continue to make the mark-to-market transfers should the market be moving against that position for some time to come. But if you connect that with the previous discussion of those fat finger errors, or just those quick dips in the market, then you'll see that we would then potentially close out a lot of people that would have actually been fine if this move never happened. So it is counterproductive to some extent. It doesn't provide for the nicest trading experience. So now the price monitoring comes into play, and price monitoring is meant to detect those large moves and give market a little bit more time to react when they happen. I've installed some sort of a drawing up, so let's see how I cope with it. But yeah, so we have the time here on this axis, and that is the price, the mark price in the market. As you know, at Vega, all the markets begin with an opening auction, right? And just to briefly cover the auction. So when a market is an auction, remember how I mentioned that as soon as the orders cross, a trade is generated. Well, all that auction really means is that this no longer applies, and those orders can be crossed, right? So there could be buy orders that are for more than the cheapest sell orders, and the market will keep accepting those prices for as long as the auction is set for. And at the expiry of the auction, it will see how many of them were crossed. It will generate the relevant trades, and the last traded price will be, I mean, there will actually be a single price for all the trades in the auction, and that price will be the mark price. The market will go back to continuous trading mode. So, you know, again, as soon as the order crosses, those orders are taken off the book, they result in a trade, and everything carries on. So we will have an opening auction, and let's say that, so that's, this is where our opening auction ends. And let's say that the price was something like 100 here, right? So we start here. And this is where the price monitoring is getting primed. So that's the first price it ever sees. And this allows it to get a bit of a feel for what the price levels are in this market. And then all of our markets have a risk model underpinning them, right? And the risk model is used to estimate how risky the market is or how volatile it is. And that then drives the collateral levels. So it basically, the more volatile the market, the higher the margin you have to put for a position of a given size. So the lower the maximum leverage that you can attain. And what price monitoring does is it specifies a list of triggers, and each of those triggers has a horizon tau and a probability level P. This is time 0, right? So let's say this is time tau. So we use the risk model to get the, because these are stochastic differential equations, so they basically allow you to get a series of distributions of a price at any point in time. So we can project to the time tau, and we can get the distribution of prices, which might look something like this. And we know that we want, and let's say, so tau can be, I don't know, 1 day. And the probability level could be 95%, and excuse my handwriting. So then what we want is we want theoretically 95% of the time for the prices to be within, let's say, that range, right? So all of this will be 95%. There will be 2.5% left in each of the tails. And this can imply price levels for us, right? So let's say this is something like, I don't know, 80, and this is 130, right? So then the price monitoring is set up, and between 0 and tau, if the prices ever breach those levels, so the price will continue as the orders are made. And as long as it stays here, that is fine, it just continues. But if it were to suddenly drop here, then we would go into auction, of duration, let's say delta, right? So delta could be something like 12 hours. So then for that time, the market is in auction. So the orders are collected. They can be canceled, amended, more orders can be added. And the order book just holds them together, and then the market will resume at some price. And this trigger is then no longer active, right? So this is quite crucial to understand, I think, because often when those things are mentioned, people think that it's some sort of a, let's say, censorship of a market. That, you know, we just say the price in this market will never be less than 80. But obviously that wouldn't be a great market, because if there were some real underlying reasons for the price to go below 80, that would happen on the other exchanges that don't have this mechanism in place, and it would be basically arbitraging against Vega. So there's nothing stopping the price from, you know, maybe after the auction, it actually starts here, right, at something like whatever, 30. So there will be a bit of a discontinuity in the price, and it will start here. And the important thing is that once we leave the price monitoring auction, we re-estimate this probability level given the new price that came out of the auction. So then we'll be at some T2 plus tau, right? And again, we'll get some distribution from the model. It will give us some levels, and I think we'll continue, right? So we'll carry on like that as long as it never makes it to this level. The auction will never be triggered. If it does, it will be the same as it was. One thing to note is that once we're past the tau time, then we are always getting the reference price from, so if we're at T3 now, the reference price at point T3 will be T3 minus tau. So the reference price will be moving, and it will be checking relative to that price. So the bounds will be sort of a straight line to begin with, but then they will fluctuate somewhat with the price, the reference price as given by the tau. Yeah, sorry, perhaps not the nicest drawing, but I don't use the iPad that much. Hopefully that's enough to give you an overview of the theory behind it. Yeah, sorry, it was either that or spending the whole day trying to make visualizations in Python, and I would love to do that, but it just wasn't one of those days when I could do that, because there was some other work to be done. But now that we got that out of the way, so there's one market on testnet that Ashley has kindly created, and you know, most markets on testnet will have bots, right? So there will be a lot of action on them. This one has bots switched off, so it is a fairly boring market, but that's exactly what I wanted, because well, I like boring markets, and also it's way easier to show you guys those things on something that isn't as fast moving as a typical market. Let me move the Zoom thingy and grab some water. Okay, so it's not your typical view of a market. I've closed the windows that I don't think are relevant, so this is more readable. And as you can see, the market is currently in continuous trading mode, and it's got those two price monitoring triggers set up, right? They both use, oh yeah, sorry, one digression before we dive in. If you remember from the drawing, I was discussing one price trigger, but there could be as many price triggers as the person setting up the market wants. So they could be for different horizons and for different probability levels, and they could, so these both use the same horizon, but they work on different probability levels, and they have different auction extensions, right? So if we breach this probability level, then we enter the price monitoring auction of 1 minute. If we breach this one, then the resulting auction extension is 90 plus 60, right? So 150 minutes because we've breached both of them at the same time. And then the UI gives you, so it tells you what the reference price is. So that's the price from 12 hours ago. And if the market isn't 12 hours old, it's just the first price traded in the market after leaving any auctions. And so those settings and that reference price imply a minimum valid price of 81 point something, but let's just focus on integers, and a maximum of 119, right? So as long as the price is within those bounds, no auction will be triggered. And then this other level that has a higher probability level implies wider bounds. So if the price drops between 73, the auction of 150 minutes will get triggered. And if it goes above 132, auction of the same duration will get triggered. So let us now try and trigger some auctions. So we know that if we go to something like 80, we should be triggering one auction. So let's put a short order for 80 of size 1. It's pending. Yeah. Okay, we can see that it's now on the book, and I'll now go to a different browser because wash trades aren't allowed on Vega. So if I would try to enter the opposite trade from the same wallet, the trade wouldn't get executed and the order would get canceled. I've set up another identity here, and in here I could go 80 long. So that should cross with that other order. Yeah, let's see. Yeah, sorry, the UI is still getting polished to accommodate those auction extensions nicely. So you will have to bear with me. We might have to do a few refreshes to get this right. Okay, back to Chrome. Orders. Okay, sorry, let's have another order. So good to cancel short. And in here, we actually want, yeah, good till cancel as well. And we go long. Yeah, let's see the open orders, order history. Yeah, okay, so the beauty of doing a live demo, things are not doing what you'd expect them to do. Okay, there now is a buy for 80. Okay, we don't seem to have this order anymore. Let's check the, yeah. let's go to the other guy. Okay, let's start from short now. Make sure it makes it on the book. Okay, yeah, so this is active. So fingers crossed. If we now here and go long, yeah, okay, cool. So we're now in the auction. And what happens when those orders meet is that the trade doesn't get generated. So the price monitoring works preemptively in a way. So it's not like there was a big move and only after the fact we say, okay, let's go into auction, because that wouldn't have this effect of stopping people from unnecessarily being closed out if this is just a a temporary blip in the market, if there isn't any real cause for it. And those orders will, if they are of the relevant type, so the type that is relevant for both the continuous trading and the auction, they will just be on the book for auction, and they could get canceled if the parties that submitted them wanted to do that. They could get amended. More orders can come in, and after the auction time, trades will get generated and the thing will carry on. If there are no trades, then that's fine. We'll just wait till the end of the auction and we'll carry on from the last mark price. Right? So I think now the auction has concluded. Those trades were generated. Yeah. Yeah. Okay. So there might have been some more orders in the market, but so it concluded at 89. So these are the new min and max, right, that we had. So now if we maybe go the other way, as long as we're above 108, the auction will get triggered. Again, let's go short on this one. Okay, why is it rejected? Okay. How's my collateral looking? Pretty healthy. And if from the other side we go short, yeah, we should eventually go into auction. Yeah, we did. And if we now actually cancel this order and submit another one, that's let's say 120, that would breach the second level. The other one cancels, that one goes 180 long. Then what's going to happen is, so we first breached this trigger, right? So the auction was 60 seconds to begin with. We were allowed to cancel the orders during that time. As you have seen, if there were more parties in the market, I mean, there's nothing stopping anyone from joining the market if anyone wants to jump in. I think for now it's just my two selves from different addresses. And so it's going to wait for 60 seconds, and then it will see that the new price breaks the second trigger, because the first trigger is no longer active because it was triggered. But if the price would have broken the second trigger, then the auction gets extended for another 90 seconds. It will carry on, and after that time, the price will, the trade will get generated. Price monitoring bounds will get recalculated, and the market will carry on. And this is the general theme in Vega, that there's triggers for opening, for entering and leaving auctions of any type. But in order to leave the auction, you have to both trigger the exit trigger for that auction type, but also not trigger any entry triggers for other auction types. That's just because we don't want to go in and out of auctions. We'd rather just extend the auction period for as long as necessary, so that then we can comfortably come back to continuous trading and hopefully remain there for quite some time. So for instance, it could be that there's so much trading in this price monitoring auction that the liquidity provisions don't support it. Like, this market is very well supplied in liquidity, because as you can see, the target stake is less than 1 DAI, but we've got 10,000 of DAI of supplied stake. But it could be that there's so much interest in this price monitoring auction that we cannot support it with the liquidity. So then we go into the liquidity extension of a price monitoring auction and we carry on. So yeah, this has now left the auction, I believe. Yeah, and you can see that we're now the reference price is 144. We've recalibrated the trigger and we're carrying on. So yeah, this isn't so much stopping the market from going to any place, but this is kind of putting some brakes on and saying, because auction, in continuous trading, you move the price by just, as long as there's two trades matching, you move the price. So that is a fairly weak signal, let's say. In auctions, you opening the book for some period of time where you're just gathering data from the market. So people are giving their bids what they think this asset is worth. And from that larger data set, we are determining the new price to go to and carrying on. So this isn't really censoring the market, right? But it is affecting its trajectory, because we will have this period of, continuity when the price is constant, because it's the last traded price until we determine the new one. So it obviously has some effect on the market. And this effect could sometimes be to someone's benefit potentially, right? Maybe the market is moving against them, but they hope it's going to turn any minute now. So they would try to trigger the auction and sort of wait it out so they don't get closed out. So for that reason, it wouldn't be great if those things could be triggered at will cheaply by anyone. And here, what I'm doing, I'm just submitting two orders, right, from two sides. I always get a match because I stay within the bid-ask spread here is quite big. I think it's an auction again, but yeah, the spread is 100, right? So there's tons of space to place orders in. So I can very cheaply do that. But in reality, on some other market, right, something like this, there's all those orders, right? So if the price monitoring bound was, I don't know, 21, I would have to spend tons of cash so that I can eat up all of that volume and actually move the price there, and trigger the auction. But since if you remember, we said that those auctions work preemptively, so I don't actually move the price, but it's just that if the price would have been moved, we go to the auction and then we process all the orders, including the one that was just submitted and that would have moved the price in the absence of price monitoring auction. Then, sorry, I've confused myself with all the would haves. Yeah, but basically, I would then only need this capital for a tiny period of time so that I can fake this move. And as soon as it goes into auction, I just cancel my order. I reclaim the collateral and I can return it if I borrowed it from somewhere. And then I've bought myself, in this case of a more realistic market, I bought myself a 10-minute auction, right? So it could still be worthwhile. So one way that we safeguard against that is that this auction, the order causing the price monitoring auction has to be persistent. As persistent means it will still remain on the book even in the event of the auction. So we're now in continuous trading. So I've got this good for normal only order type. And let's check our latest bounce. Okay, so if I go to 100, I should trigger both those triggers, right? It's not very long. 100 long, but I make it good for normal only. So good for normal only means this order will only get executed and possibly result in a trade in continuous trading mode. If between when I place it and it possibly gets matched, the market goes into auction, then this order just gets canceled, right? So that would be a very cheap and sure way for me to trigger those auctions at will quite cheaply. We were in Firefox, now back in Chrome. It was 100, we were long, so now we go short. And let's give it a moment to make sure we're seeing the latest data. Yeah, but in this case, those orders just got canceled because they weren't of the relevant type they weren't persistent orders, so they wouldn't have stayed on the book even if we triggered the auction. So we never really triggered the auction. We just ignore those, we cancel those orders and we carry on. And I believe that is all. I hope it was useful. Sorry if at times it wasn't clear enough, but I have tons of time now, so if anyone wants to ask on Twitch or then jump on the call and discuss this to any level of detail, I'm very happy to make up for any possible sort of mental shortcuts that I might have made when giving this demo. So I'll stop sharing now and I'll go back to Dagan.
Thanks for the demonstration on price monitoring, Witold. It's actually quite interesting because it's one of the unique things about Vega and the fact that there's constantly new markets and proposals and searching for prices. So I hope this was like a useful deep dive into the mechanisms that go behind it. And if anyone wants to ask any further questions, they're free to ask Witold in the follow-up Zoom call after this. We had one question, but it wasn't so much on price monitoring, more about general trading on Vega. And I wonder if you know the answer. I will ask it now. Brunswick asked, is it possible to buy, you were looking at the uni market. So he asked, is it possible to buy at 20 at 10% leverage and then set a sell trigger 2 on the same asset, taking profits maybe on the buy that you made at 20 and then switching to 20% leverage short. So can you do that in the same order? A bit like, you might have tried that before on another exchange.
You cannot do it on Vega because one, your orders always net. So if you go, let's say 10 long, 20 short, your net position is -10, so you're 10 short. On some exchanges, I know it's possible to, these are kind of separate events and you're kind of both short and long, but because we want the netting of the risk, we're always netting your positions. And also it's not possible to control your leverage in this case and set it to 2 different levels because your leverage is, so your maximum leverage is given by the margin amount, by the search level to some extent, because then it will get liquidated. But you can go as low as you want with your leverage. It can be even under 1 if you want to. And that's just driven by the balance in your general account. So I hope that answers your question. If not, then please come over to the room and we can carry on.
Yeah, that makes it clearer for me. And I'm sure hopefully for Brunswick too. He said, they said they tried it on the testnet and then it didn't work out very well. So hopefully the explanation explains why. I've posted the Zoom room in the, yeah, he said, yes, it does. Thank you for answering the question.
Yeah, no
Yeah, I hope that, I hope that was informative. The recording for this Vega Fairground Jam will be available on YouTube within the next day or so. You can find a playlist of all our previous different testnet Fairground Jams on our YouTube channel. And if you have any requests for things you would like us to cover or do more of in future sessions like these, do let us know on our Discord server, on our Telegram, and we'll try and get the appropriate person on the team or someone, a special guest, in to talk about that element of Vega. I've given the link for the Zoom room, so I think I'll end the live stream here. Thank you again, Witold, for going into price monitoring, and we'll see you in the Zoom room. Bye.
Yeah, no worries. One announcement, actually, we'll be running those research office hours. So it's going to be Wednesdays at noon UK time. So either myself or someone else from the team will be available in an open Zoom room. So if anyone would like to discuss, either this or anything else from Vega or just anything really, come over and we can have a chat.
Yeah, apologies, I missed that. We're holding a new event series every Wednesday at 12 p.m. UK time, where we're going for an office hour with Witold or other people in the research team, and we'll be talking about the research conduct of Vega. So do pop along to those if interested, and we'll be publicizing them more in the coming days. Okay, see everyone in the Zoom room. Thank you again. Until next week. Bye.
Thank you.